Welcome to this explainer. I am absolutely thrilled to have you here today. Okay, let's just dive right into this, because today we're unpacking literally the ultimate stress-free path to understanding investing. And the best part? We are completely skipping all that confusing Wall Street jargon. You know, if you've ever felt like building wealth is some exclusive club with a secret language, well, you are exactly in the right place. We're going to distill decades of financial wisdom into a straightforward strategy that absolutely anyone can use.
So, tell me, have you ever felt totally overwhelmed by the mere thought of investing? If so, you're definitely not alone. It's incredibly common to feel that beginner's anxiety. Trying to navigate through thousands of mutual funds, crazy high management fees, and complex financial products, it's exhausting. It honestly feels like the system is rigged to confuse us. But what if I told you that you don't need a fancy finance degree to outperform most professional investors?
Here's a quick roadmap of what we're going to cover in today's explainer. We'll start with the investing complexity trap, check out Taylor Larimore's simple solution, take a look inside the three funds, figure out building your personal mix, and finally, we'll talk about staying the course. All right, let's kick things off with Section 1, the investing complexity trap. To really understand this trap, we have to look at how the financial industry actually makes its money. First up, we have the Wall Street way. This approach is packed with active manager risk, the intense, nail-biting stress of trying to pick individual winning stocks, and honestly, outrageously high fees, sometimes up to 2%. And sure, 2% might not sound like a lot right now, but over a lifetime, those fees will eat massive chunks of your potential returns. But then we have the Bogleheads way. This is all about near-zero fees, incredibly broad diversification, and ultimately, peace of mind. The evidence is super clear here. Picking individual stocks is basically a gamble, and relying on expensive active managers usually just leads to underperforming the market anyway. Moving right along to Section 2, Taylor Larimore's simple solution. It's time to introduce our mentor for today's explainer. Meet Taylor Larimore. He's a 98-year-old World War II paratrooper, a former IRS officer, and widely celebrated as the king of the Bogleheads. And what's really fascinating about Taylor is that he spent decades working with complex portfolios and market timing strategies, only to have this huge realization: the market was beating him. So, with over 7 decades of financial experience under his belt, he completely abandoned all that noise in favor of an extraordinarily minimalist strategy. This transformation of his brings us to a really foundational quote: "Simplicity is the master key to financial success." Those are the words of Jack Bogle, the legendary founder of Vanguard and the pioneer of the index fund. Taylor Larimore actually credits Jack Bogle with changing his life. And it was this profound emphasis on simplicity that inspired Larimore to champion what we now know as the famous three-fund portfolio philosophy. Okay, let's get into the mechanics in Section 3, inside the three funds. So what exactly is a total market index fund? Well, instead of trying to predict the future and pick the one stock that's going to skyrocket, an index fund just says, hey, I'll own a tiny piece of every single company in a specific market. Jack Bogle had a brilliant analogy for this. He said, don't look for the needle, buy the haystack. And it makes so much sense, right? By buying the whole haystack, you capture the average return of the entire market with virtually zero effort and absolutely zero guessing. Now, here are the 3 pillars of Larimore's strategy. Fund number 1 is the total U.S. stock market. This single fund holds tiny pieces of over 4,000 large, medium, and small companies right here in the U.S. Fund number 2 is the total international stock market, holding over 6,000 companies globally. And finally, fund number 3, the total U.S. bond market, which contains over 8,000 high-quality bonds. Think about that for a second. By owning just these 3 funds, you instantly get global diversification across more than 15,000 securities. It's elegantly simple, yet incredibly comprehensive. 0.04%. Just let that number sink in. This brilliantly illustrates the power of the whole strategy, because 0.04% is a typical expense ratio for a broad index fund. Contrast that with the 1 or 2% being charged by those active managers. Keeping your investment costs rock bottom low is, without a doubt, the single biggest secret to long-term wealth accumulation. Because at the end of the day, you get to keep exactly what you don't pay for. Next up is Section 4, building your personal mix. Let's see how to adapt this to your goals. Now that we know what the funds are, how do we actually combine them? Well, a typical mix for a younger investor might look something like 50% in U.S. stocks, 30% in international stocks, and 20% in bonds. When you have a really long time horizon before retirement, you can afford to take on a bit more stock market risk. Yes, stocks are volatile, but they also offer the highest long-term growth potential. That 20% in bonds, that simply acts as a little shock absorber for when the market inevitably gets bumpy. But now let's compare that to an investor who is getting pretty close to retirement. Their mix might shift to 30% US stocks, 10% international stocks, and a massive 60% in bonds. As you get closer to actually needing your money, preserving that capital becomes the absolute priority. You anchor your portfolio with bonds to provide safety, income, and stability. This ensures that if a market crash happens right before you retire, it doesn't completely wipe out your life plans. So a great question here is, how do we maintain this simple mix over a long time horizon? It really all comes down to rebalancing. Step 1, check your target allocation. Let's say it's that 50-30-20 mix we talked about. Step 2, see where your portfolio has drifted. For example, if US stocks had an amazing year, they might now make up 60% of your portfolio instead of 50%. Step 3, simply direct your new savings to the underperforming asset class to bring the balance back, or you can sell the winners to buy the losers. This is a remarkably simple maintenance routine, but it forces you to automatically do what everyone says you should do, buy low and sell high. Which brings us to our final section, Section 5, Staying the Course. Setting up this 3-fund portfolio is the easy part. The behavioral discipline required when financial news gets scary, well, that's the real challenge. Think back to the 2008 bear market. The US stock market dropped almost 51%. The international market dropped nearly 59%. I mean, that is genuinely terrifying. But look at this. The US bond market actually went up 5%, acting exactly as that crucial shock absorber we mentioned earlier. And the eventual outcomes? The US stock market fully recovered in just 37 months. The point here is that while massive drops absolutely do happen, having broad diversification and a solid bond allocation will protect you. But, and this is a big but, only if you don't panic sell. And this leads us perfectly to Jack Bogle's ultimate directive. Stay the course 1,000 times, and I meant it every time. This is also Taylor Larimore's essential golden advice for anyone seeking financial freedom. When the market dips, and it will, keep what you've got. Just ignore all that loud, scary noise coming from Wall Street and the 24-hour news cycle. You have to trust the long-term math of holding the entire haystack. That brings us to a final, slightly provocative thought I want to leave you with today. Will you let Wall Street noise dictate your future? Or are you going to choose the simplicity of the haystack? Because remember, the 3-fund portfolio is definitely not a get-rich-quick scheme. It is a get-rich-slowly, sleep-very-well-at-night strategy. It empowers you to take absolute control of your financial destiny, maximizing your efficiency while minimizing your stress. Thank you so much for joining me for this explainer. I really hope this structured look at Taylor Larimore's wisdom helps you build a much clearer, wealthier future. Catch you next time.